The Bogleheads Guide to Investing, co-authored by Taylor Larry, Mel Lindauer, and Michael LaBeouf, is a comprehensive resource for individuals seeking a sensible, long-term approach to personal finance and investing. Inspired by the investment philosophy of John Bogle, the founder of Vanguard and the creator of the index fund, the book offers clear, practical advice based on simplicity, low costs, and a focus on long-term wealth accumulation. Chapter 1. Choose a sound financial lifestyle. The book opens with the foundational principle of living below your means. This is the bedrock of investing. Without proper control over spending and saving, there is no money left to invest. The authors emphasize the importance of paying yourself first by consistently saving a portion of your income before spending on discretionary items. The Bogleheads stress that financial success is not about earning a high income but about managing what you have, budgeting wisely, and avoiding unnecessary debt. Chapter 2. Start early and invest regularly. Time is one of the most critical factors in wealth building due to the power of compound interest. Starting to invest early allows your investments to grow exponentially over time. The authors stress the importance of regular investing, regardless of market conditions. By contributing a fixed amount at regular intervals, an approach known as dollar-cost averaging, you can mitigate the risks of market volatility while maintaining a disciplined approach to saving. Chapter 3. Know what you're buying. Keep it simple. Simplicity is key to successful investing. The Bogleheads advocate for an easy-to-understand, straightforward approach. They discourage chasing after complex financial products or trying to time the market. Instead, the best strategy for most investors is to buy and hold low-cost index funds, which reflect the performance of the entire market or a broad segment of it. This approach ensures diversification and avoids the risk of picking individual stocks, which can be unpredictable. Chapter 4. Asset allocation. One of the core principles of the book is asset allocation, which is the process of spreading your investments across different asset classes, such as stocks, bonds, and cash, to balance risk and reward. The authors emphasize that the right asset allocation is essential for long-term investing success and should reflect both your risk tolerance and your investment time horizon. For most investors, stocks offer the best potential for growth, but come with greater risk, while bonds provide stability and income, but with lower returns. A balanced portfolio typically combines these asset classes in a way that aligns with your goals and risk appetite. The authors suggest adjusting your asset allocation as you age, generally increasing the bond allocation as you near retirement to reduce risk. Chapter 5. Index funds. The Bogleheads' weapon of choice. Index funds are the cornerstone of the Bogleheads' investment philosophy. These funds aim to replicate the performance of a specific market index, for example, the S&P 500, rather than trying to outperform it. They are low, tax-efficient, and diversified, which makes them ideal for the average investor. The Bogleheads argue that active fund managers often fail to consistently outperform the market after fees, and that individual investors are better off investing in index funds with minimal management costs. Vanguard is frequently cited as a provider of some of the best low-cost index funds. Although the principle of index investing can be applied to funds from other companies as well. Chapter 6. Costs matter. One of the most important concepts in the book is that investment costs, such as expense ratios, commissions, and taxes, can significantly eat into returns over time. The authors stress the importance of choosing low-cost investments to maximize your wealth over a lifetime of investing. High fees can drastically reduce the size of your portfolio. By minimizing costs, whether through investing in low-cost index funds or using tax-efficient strategies, you increase your chances of success. Chapter 7. Keep it simple. Focus on the big picture. The Bogleheads emphasize simplicity throughout the book. They advise against frequent trading, trying to predict market movements, or chasing after the latest hot stock or fund. Instead, a simple, low-cost strategy focused on long-term goals will yield better results. The authors recommend using a 3-fund portfolio as a model for simplicity. This portfolio consists of 3 broad index funds, a total U.S. stock market index, an international stock market index, and a total bond market index. Chapter 8. Diversification and Risk Management. Diversification is another key element of the Bogleheads strategy. By spreading investments across different asset classes and geographical regions, you reduce the overall risk of your portfolio. While diversification doesn't eliminate risk entirely, it does minimize the impact of any one investment performing poorly. The authors recommend international exposure through an international stock index fund, in addition to U.S. stocks and bonds, to ensure broad diversification. Chapter 9. Stay the course. The importance of discipline in investing cannot be overstated. The authors advocate for a buy-and-hold strategy, urging investors to avoid reacting to short-term market fluctuations. Staying the course means maintaining your asset allocation through both good and bad market conditions, attempting to time the market. Buying in at lows and selling at highs is nearly impossible, even for professional investors. A consistent, long-term approach to investing, in which you stay invested regardless of market conditions, has historically proven to be the most successful. Chapter 10. Tax efficiency. Tax efficiency is crucial for maximizing returns. The Bogleheads highlight the importance of investing in tax-advantaged accounts, like IRAs, individual retirement accounts, and Ceiling EKS, which allow for tax-deferred growth. Additionally, they recommend placing tax-inefficient investments, like bonds, in these accounts, while tax-efficient investments, like stocks or index funds, should be held in taxable accounts. This strategic placement of assets can significantly reduce your tax burden. Chapter 11. Tune out the noise. The Bogleheads stress that investors need to tune out the constant noise from the financial media. News headlines, financial pundits, and market forecasts can create anxiety and lead to impulsive, emotional decisions. The authors argue that the vast majority of this information is irrelevant to a long-term investor. Instead, they encourage investors to focus on their financial plan and stick to it, regardless of what is happening in the market. Chapter 12. Giving back. The book concludes with a chapter on giving back to the community, which is in line with the Bogleheads' philosophy of living a balanced and purposeful life. Once you've achieved your financial goals, the authors encourage sharing your wealth through charitable giving, volunteering, and helping others achieve financial literacy. Conclusion. In summary, the Bogleheads Guide to Investing offers a simple, clear, and effective approach to personal finance and investing. Its core principles: living below your means, investing regularly, maintaining a diversified portfolio, minimizing costs, and staying the course provide a reliable blueprint for building wealth over time. The focus on low-cost index funds, asset allocation, and tax efficiency forms the foundation of the Bogleheads investment strategy, which is accessible and suitable for both novice and seasoned investors alike. The Bogleheads philosophy rejects market timing, stock picking, and complex financial products in favor of a long-term, patient approach to wealth building. By following these guidelines, investors can minimize risk, maximize returns, and ultimately achieve financial independence.